There are countless videos on this channel regarding debt weapons, folks. I'll summarize it for those of you who might be new. A debt weapon is a term that we gave to really any resource that can help you maximize your cash flow. And a lot of those happen to be lending instruments, tools you can borrow. And there's sort of this hierarchy that you'll find when exploring these available tools. Some of them we prefer, some of them we really only rely on if absolutely necessary. I can't stress enough that I think it's very important that you utilize leverage with extreme caution. And the more you can focus on tools that minimize your risk, the better. So those high interest types of tools, I would certainly encourage you to avoid right now, if not indefinitely. But yeah, home equity line of credit happens to be one of my favorites. And I like home equity lines of credit as a resource for taking advantage of opportunities, because they have over many, many years come with extremely low interest rates. They're usually an interest only payment. They do happen to have a variable interest rate, which obviously you have to be careful with as well. But a home equity line of credit has complete liquidity. And that's really what we concentrate on here is being able to take that surplus of cash flow that doesn't necessarily have a purpose and slam it against our debts, and really marry the two concepts between the Dave Ramsey, who believes you should never borrow even for a home, up to the other side of the spectrum, the rich dad, poor dad, Robert Kiyosaki approach of borrow, 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 and invest into speculated returns that exceed the cost of the money you're borrowing. And we've really brought those together into this powerful hybrid concept of hating debt and simultaneously loving leverage. And so the ability to overcome the contradiction inside that statement is being able to pay those debts off in record time. And that's where, if I took a $50,000 debt weapon and paid it off to $25,000 in about a year, it's paid in full in 2 years. That's much faster. That is extremely accelerated from what the home equity line of credit requires from me. And it also then cuts heavily into the cost of interest of using that tool. But to my point, it's also still preserving the liquidity. Being able to take that money and apply it towards a debt weapon like a home equity line of credit. And the reason I love HELOCs is that I can just borrow against that tool again. So for those of you who have not yet pursued tapping into this, the newfound wealth tucked away inside your property, and accessing a home equity line of credit that can be used when you need it, if you want it, you're making a huge mistake. And right now, based on existing values, you probably have one of the better chances of getting it, but that is going to be shifting. And as things economically change, so then do the underwriting guidelines and the response from the banks when you submit an application. So very important for people to be taking advantage of these, of getting out there and getting access to these tools immediately. So when I'm working with people one-on-one in our coaching, and again, you can check out our memberships through VIPfinancialed.com. I'm usually encouraging people go out there and get access to tools that are available to them, especially tools that don't necessarily have much, if any, expense whatsoever. My HELOC was completely free for the first year, and then I pay $150 per year as a processing fee of some kind, right? It's either $150 per year for that fee or interest, whichever is greater, okay? That's inexpensive. They didn't require an appraisal at the time. They didn't require title work at the time. They waived all the other fees that were involved. Literally no money out of pocket. And wouldn't you know it, I actually got the damn thing closed in just 10 days, which is one of the best experiences I've ever had with a bank. I generally tell people to expect the worst. Working with the banks sucks. I'm constantly gritting my teeth. I can't stand it. It doesn't matter how much practice I have and how many little tips and tricks I've developed over the years. I've just never enjoyed.
It's still never fun. Yeah.
It isn't.
Did
It
you
isn't.
did you go with your original lender on the HELOC?
So the home equity line of credit I got was actually through Ent Credit Union, and they have a pretty small footprint. So doing research on this is extremely important. And for those coaching members that enroll, we actually give a debt weapon cheat sheet, which is an amazing tool that actually helps them go through the process of finding and applying for the right tools for their needs anytime for the rest of their lives. So it's not a, hey, you should fish in this fishing hole, and then all of a sudden those fish are gone and that resource is no longer valuable to you. It's a, how do you find the right fishing hole to fish in? And that's really where we're helping people the most, is understanding how to identify the proper resources for those debt weapons. But home equity lines of credit are always a really important starting point, especially with the way that property values have been going for the last few years. Are there
pros and cons of going with it with your own lender versus going out and seeking a new source?
Rates and terms vary. So that's the bottom line. You're usually, my recommendation is going to be to shop it among 3 different institutions or credit unions, banks or credit unions, in order to lay them side by side. And you may have pros and cons of each, but ultimately I think the leading tool will be fairly obvious once you've compared to several providers. Usually home equity lines of credit on non-owner occupied properties or investment homes are extremely difficult to find. I'd be surprised if there were more than a small handful that are currently providing that right now.
That is super rare. Yeah.
Very, very rare. There's actually this interesting website. Let's take a look at it. I had heard about this debt weapon called Figure. It says figure out your finances in minutes. This might be an interesting one to look into as a debt weapon resource. Looks like they've got pretty good reviews, funded over $3 billion. They offer a simpler, faster way to find the loan that's right for you. Apply 100% online in minutes. They offer a home equity line of credit.
Type.
I don't think so. I think Lending Tree is more that fintech, higher interest stuff. And usually they're not fintech, any type of fintech's usually not really collateralized. I don't think Lending Tree offers home equity lines, do they?
No, they don't. Well, that's not accurate. Yeah, because I think Rocket's got a product through Lending Tree that is doing HELOCs. Could be wrong, but I'm fairly certain. I've not been on.
Well, I've had great experiences with Rocket. But here we are with this home equity line of credit. Looks like they'll lend up to $400,000, fund very quickly in as little as 5 days. That's really rare. 5, 10, 15, 30-year fixed options. That's cool. We've got mortgages also through them. Looks like they'll do cash out refis. They'll do jumbo, and then they look like they'll do even crypto mortgages as well. So this is pretty cool. Looks like they'll collateralize your cryptocurrency portfolio. Again, you just have to be prepared for changes in the economy to influence what your lender does with you. And in the last downturn, home equity lines of credit were frozen commonly. And it was the highest combined loan to values first on down. So if you had call it 60% loan to value on your first mortgage, and you wanted to get a 30% second in the form of a home equity line of credit for a combined or CLTV, combined loan to value of 90%, that would generally be frozen, meaning the bank would cut off your access to that. You couldn't then borrow against it any longer, yet you were still responsible for the minimum payments every month. Before they would cut off an 80% combined loan to value, which would then be cut off before a 70% combined loan to value. So the less you're asking for in relation to the value of your home, the higher the likelihood that your ongoing access to that will continue to remain available to you. And I think it's very important for people to understand. So just because it might be available today doesn't mean it'll be available tomorrow, whether you already have been approved for it or not. They can take it away from you. So use that strategically in your thought process when you're just really deciding how much you want to tap into, because becoming greedy on that might come back and shoot you in the foot if you're really hoping to have access to it down the road and we see a 10, 20, or even 30% decline in market values across the country.
What's a good rule of thumb rate that they should be looking for? I mean, what would you consider a good rate if you were out shopping?
Good interest rate?
Yeah,
Oh, it's attached to prime, so it's irrelevant.
so prime plus.
Exactly. And prime, and it could be prime plus a half, prime plus a quarter. I mean, again, it's an adjustable rate, and it looks like obviously Figure will come in and actually offer you some fixed options, which is fine. But generally speaking, you're going to see that those lines of credit are adjustable. So I'm not as heavily focused on the rate as much as I am the terms. I want to understand what my repayment options are. Some of them have a 10-year repayment at interest only, at which point it's then reamortized over the following 20 years with the principal portion included. So your payment would obviously increase substantially after a 10-year period. Some of them offer longer or shorter than that. Some of them have higher annual fees. Some of them have more in closing costs or might require an expensive appraisal to be done. So those are the types of terms I'm laying side by side to make a decision. Usually the rates are going to be pretty comparable.